Imagine being able to anticipate exactly what the market is going to do before it does it. Almost like Nancy Pelosi, but you're not conducting an illegal activity like insider trading. In this video, we're going to be overviewing an entry model that every single one of my students has mastered and they are absolutely printing with. So without further ado, let's go ahead and dive into it. Now, what we're going to be overviewing is an order block entry model. And for anybody on here that doesn't have the context of what exactly an order block is, I'm going to pull this up in my institutional trading dictionary. This is something that every single one of our students has access to, and it basically gets the nitty-gritty details and kind of puts into perspective exactly what certain concepts are that we use with our style of trading. And so an order block, simply put, is a point of interest and price zone where institutions have placed large orders, creating a footprint of their activity. These areas represent accumulation for bullish intent or distribution for bearish intent, often preceding a significant market move. Another thing I'll say here is that order blocks tend to capture liquidity, and we're going to see that in the next paragraph here. Order blocks signal the origin of institutional buying and selling pressure. They are most commonly seen at turning points in the markets. When you see a trend shift from being bullish, creating higher highs and higher lows, to then pivoting and going, bearish, or seeing a retracement, or whatever the case may be, bullish to bearish or bearish to bullish, you will typically see order blocks as the turning points in the market. And this is where smart money reverses price by engineering liquidity grabs before driving price in the intended direction. And so that is the kind of dictionary definition of what an order block is. An example would be these last kind of couple up close candles prior to the sell-off we saw here. Or even more specifically, and what we're going to be going over in this video, is these last few up close candles prior to a major sell-off where we actually do see a shift in the overall order flow, where price is creating higher highs and higher lows in market structure's perspective. We end up actually seeing this was the last hurrah before price went and created a lower low, kind of giving a market structure shift. And so this is a very simple three-step framework that you can use to actually identify entries and opportunities in the market. So what exactly is the framework? Well, the framework is this as it's being shown on screen. So number one, you want to identify the trend. Okay, are we in a bullish environment? Are we seeing higher highs and higher lows? You want to wait for a shift in that trend. As soon as you see a shift in the trend, that is going to be what signifies, okay, pay attention, look for opportunity, look for that order block to potentially find an entry. So here on this example, we're seeing a very, very bullish season of price action, or a couple weeks of price action on Bitcoin on the hourly time frame. And then what do we see, right? We're seeing these higher highs and higher lows being created, and then eventually we end up seeing a lower low. That is a shift in trend. Now, whether that's a short-term or a longer-term shift, of course, that is going to be dependent on other elements of analysis that we won't get into in today's video, but nonetheless, this is as simple as it gets. Look for that market structure shift. That's step number one. Step number two is identify the order block or the liquidity sweep that was the catalyst to the market pivoting. And so in this particular instance, okay, we have this sell-off, we have a bounce, then we get the market structure shift. The context of this last few kind of up close candles, this last kind of high prior to going and creating this low, is that this is ultimately what was the cause of this effect. Okay, now why do I say that? Well, institutions, and I have a whole video explaining this, so I won't go into it in today's video, but if you want to check it out, you can check in the top right corner. It's exactly how the institutions trade. The institutions have to buy to sell and sell to buy, capturing liquidity. And so these two highs are what we're seeing captured prior to that major sell-off and then actually giving, that market structure shift. So we're seeing the liquidity sweep, we're seeing this order block, both of which happen before we get that market structure shift. So we're seeing the market structure shift. We've identified the liquidity sweep and we have the order block identified. Now, how do we actually go about taking an entry off of this order block? Well, number one, on the hourly time frame, this is 5 candles, 5 bullish candles. And if we drop to the 4-hour time frame, you'll notice that it's just all one candle. Okay, last up candle prior to this down move, which we then see a market structure shift on the hourly time frame from. Cause, effect. Now, the way that you would take an entry off of an order block is one of two ways, and you can do this whether it's on the 4-hour time frame, 1-hour time frame, it doesn't matter, as long as you've identified the kind of last up move before the down move, the last down move before an up move. As long as you've identified that area, you can do this on any time frame. But what I'll do is I'll take a look at and identify, okay, cool, this was the open of the first candle, okay, or if it's just one candle on the 4-hour time frame, this is the open of that candle. And then I'll also look to mark out kind of the 50% of this whole sequence of candles. So I'll take the Fibonacci tool for this, Fibonacci retracement tool on TradingView, and I'll draw from the open of the first candle to the close of the last candle. And then it'll give me that kind of 0.5, that 50% kind of middle ground with this particular area. And so I'll zone this out like so. And if we were to take a look at this on the 4-hour time frame, it'll look a little bit different. Okay, it's gonna be a little bit more than the 50%, but you could also take it off the 50% of that 4-hour candle. It's kind of personal preference, but I like to take the whole move and kind of measure the whole move and do the open and 50%. So this would be the area that I'm looking for price to return to for my entry. Why? Because these types of blocks in price, the institutions need to have price return to this area so that they can mitigate out of any sort of buy to sell positions they had in here. What do I mean by buy to sell? Again, you can check out that video on how the institutions trade. It explains it in a lot more detail, but the banks will hedge their way into the market. They will buy temporarily, sacrificing capital, to then sell and really put their money where their mouth is, so to speak, position themselves in this huge sell, which then is making them a ton of money as the market's dumping, right? What moves the market? Money. He who controls the money controls the world. One of the famous, quotes. I can't remember who said it, but same thing in the markets. He who controls the money controls the markets. It's the major banks and institutions. The algorithm, the way that it works, there are buy to sell plays happening all the time, as the same way there are sell to buy plays. Huge liquidity captures and manipulation. All of this stuff is taking place so that the major banks can get exposed in the market the way that they would like to, the most effective way, because they're trading with so much more capital than everybody else. So looking for this as your entry area, okay? You're looking at the order block, that last kind of few up close candles prior to the down move. All right, my entry is going to be from in between or off of either the open or 50% of this area. And so my stop loss, which is equally as important, if not more important, is gonna be on the other side of this order block. So buy to sell, stop loss placement will be above this high, and then I'm looking to target a new low. So at the very least, a new low beneath this one, because this is the current low, right? The current trading range is kind of this high to this low. This was the catalyst, buy to sell. So ideally, I'd like to see the next lower high created in this area to then expand and go to create a new lower low. All right, or I'll look to target, some other area of liquidity, some other low in the market that we could potentially see stop hunts take place at. So closest two areas from where current price would be these two right here. And if we were to draw out the risk to reward ratio tool, you're looking at between a 1 to 2.5 to 1 to 3 risk to reward with that particular, these particular zones. Okay. So entry, again, it's going to be off of either the open or kind of 50% of these last few up close candles. Take profit is going to be targeting a new lower low, right? Which at the lowest side of things is a 1 to 2 risk to reward. If you're looking for a run on liquidity and a kind of an extension of the creation of a new low, a little bit of a better risk to reward. And then again, stop loss placement, very important. We're going to be putting that above these last few up candles. Same thing, whereas, if we were looking at this vice versa, last few down candles prior to an up move, my stop loss is going to be placed beneath the low of that area. And so as we play out price here, we'll notice that we get a retracement up to that area. This is where we would be entered into that actual trade. And from here, we end up seeing the reaction and the sell-off all the way to target. And I believe this took about 2 days before we ended up hitting the full 1 to 3 target. But we do end up creating a new lower low just 2 days later. This was Tuesday. Here's Thursday. Thursday creates the new low. You're holding that trade for maybe a day or two. All right. And then we see a huge melt off on Friday. And I mean, this thing actually at its peak ran for about from entry to, where price is currently trading, that's about a 1 to 8.5 risk to reward ratio. So if you're risking $10, you're making 85 on that trade. If you're risking $100, you're making $850 on that trade. So this is the entry model that so many students have absolutely been able to master. It's very simple. I know this is a kind of a quicker overview, But we go into this in a lot more detail inside the community. And guess what? You can get involved. It's very simple. It's free. We do have a paid community as well, but there's a free community that you can access. If you go down to the link in the description, you'll be able to join our community absolutely for free, get some ideas, get some education, get some recordings, and live education as well. And of course, for those of you that are really looking to dial this in on another level, we do have a paid community that you can inquire about. But I would say, hey, nothing to lose. Join the free community. See if you enjoy and resonate with the community and the vibe and the education. But with that being said, I'm looking forward to seeing you in another video very soon on the channel. Don't forget to like, subscribe, all that good stuff. Much love. And until next time, peace out.